Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Good day, everyone. Thank you again for joining us for another Cambridge podcast. We're almost at the end of 2017, and it's been an incredible year in so many different ways. It's been, very challenging for many of us in the United States. We've had a number of hurricanes. Obviously, here in South Florida, we had a major hurricane as well. So at least in our situation here in our office at Cambridge, we were pretty much out of circulation for 2 months. The majority of clients obviously were very busy, trying to minimize their losses and working with insurance companies and filing claims. And many of them are still doing that today. I do have a number of clients in the Keys, and they're still dealing with all those challenges, and they may be very well dealing with many of those issues probably for another 12 to 18 months. What I wanted to do today is I want to do a financial Q&A. Now, throughout the year, we've been doing quite a number of podcasts, and we use different topics that we feel are very important for all of us. And this is more of a learning process for those of you that are joining our podcast system here and channel. And the reason for that is our number one goal is to make certain that we give you a tremendous amount of education, because the more educated you are in areas of finances, the better off you're going to be in your life and the better decisions you're going to be able to make for yourself, your families, and your business. So I have put together a number of questions that I get all the time, and I want to touch upon that as we move along. Now, obviously, it was the first year for President Trump and his group to run the country, and obviously there has been a tremendous amount of trials and tribulations along the way. I have never seen this country so politically divided in so many issues that, from a business perspective, it shouldn't be that way. So I'm going to stay away from politics. I'm just going to stick to factual information that I think is going to be very critical for you, and it may allow you to see the world from a different perspective. As an economic, with an economic background and accounting background, one of the things that I try to do is I want to peel the onion whenever someone brings an issue to the table, because not everything seems to be the way it looks on the surface. So you have to be able to peel the onion, get deep into each and every one of the issues, and identify whether it is beneficial or not to move with the decision-making process either one way or the other. One of the questions that I get from many clients, and I see this now in the news because of what's going on with tax planning in the United States. As you all know, both the House and the Senate approved their own plan, but now they're in front of committee. So they're going to go in front of a committee. They're going to try to take the best out of both plans and try to come up with one plan that can be suitable for Americans. And then obviously they have to go back and they have to vote on that plan, and they need to present that to the president for a signature and hopefully to be implemented before the end of the year. Now, there's a very high probability that the plan is not going to be available until under 2018. So for all of us that are planning for all the taxes in 2017 or doing tax planning, we're more than likely, unless they make some changes at the very end of this process, more than likely we're still going to file taxes in 2018 for 2017 under the old rules. And then in 2019, the new rules will take effect that would be implemented January 1 of 2018. So when you file your next taxes in 2019 for 2018, more than likely we're going to have a new set of rules. But because of all the confusion and the political issues and concerns that are moving the needle when it comes to tax planning, it is important to note that it's going to have to be done under budget reconciliation. It's not going to be a full tax reform, because in order to get a full tax reform, then you need 60 votes, and you're never going to get Democrats to participate in that process. So therefore, it's going to be under budget reconciliation. And as I have stated in another podcast, we talked about tax planning in the U.S., budget reconciliation is only for 10 years. So if it's going to benefit each and every one of us, some of us will benefit more than others, obviously, depending on where you live. It may not benefit you at all, but at the end of the day, it's going to benefit approximately 96% of the U.S. population. Obviously, it's almost an impossibility to benefit 100% of the population from a taxable standpoint because of how the tax laws are written in the United States. But at the end of the day, it would only be for 10 years. So in year 11, it would revert back to where it is today in 2017, unless the new president or the new group, whether it's Democrats or Republicans, decide to extend it. And obviously, we can't deal with things that we can't control at this time. So one of the main questions that I get is, are the wealthy always receiving the tax breaks? And you hear that. You hear all types of pundits, whether they're Republicans and Democrats, talking about this all the time. Are the wealthy always getting all of the tax breaks? Well, from an economic standpoint, and if you understand the system the way it works, they should. They should be receiving a large amount of tax breaks. Now you'll say, well, Bert, unless you're really, really wealthy, why are you making this comment? Why are you saying this? The reason why I say that they should is because if you're paying the majority of the taxes in the United States, whenever there's a tax break, you should be receiving a larger percentage of those breaks. If there are 5 people in a restaurant eating on a regular basis, and every single day or every single week the bill comes to $100, and now the business owner decides to say, look, you guys are very loyal customers, so instead of having the 5 of you to pay $100, I'm going to reduce your bill by $20, so I'm only going to charge $80. If we start using the tax system in the United States, the wealthiest in that table, who pays the majority of the bill to begin with, should receive the majority of the benefits. And the reason is the following. The top 1% of the U.S. taxpayers, or the wealthy, they pay 40% of all the taxes. Now, so whenever I hear someone say, the wealthy need to pay their fair share, my question is always, well, what's your definition of fair share? Is it 40%? Is it 50? Is it 70? Is it 80? Obviously nobody has been able to answer that question for me. So the top 1% pays 40% of all the taxes. The top 10% of taxpayers in the U.S. Pay 70% of all taxes. And just for your information, the top 1%, it's less than 1 million people. So about 892,000 individuals in the United States and or corporations, pay 40% of all the taxes. And I'll get into the corporate structure in a minute, but, very few people pay 40% of all the taxes in the U.S. So now we know that the top 1% pays 40%, the top 10% pays 70% of all the taxes. What most people don't realize is that the bottom 50% of all taxpayers in the U.S. pay only 3% of all the taxes. And the bottom 40% of Americans pay no taxes whatsoever. So there's a tremendous disparity between the people that pay the most amount of taxes in the United States and the one that pays the least. And at the end of the day, this is like, you borrow from Peter to pay Paul. Everything is fine until Peter runs out of money. And once Peter runs out of money, then, everything just falls apart from a business perspective. Now, another issue that I've been hearing quite a bit, both on the radio, TV, and publications that I read on a regular basis is, what is trickle-down economics? And the fact that trickle-down economics do not work. Now, that's a very interesting statement because primarily it's all but a political talking point. Because whenever somebody brings the issue of trickle-down economics, the first question that I ask is, well, can you define it for me? can you tell me what trickle-down economics is? And all of a sudden, now they really have no clue and no idea as to what it is. Why? Because they heard someone in the radio talk about trickle-down economics and the fact that it doesn't work and so forth. So those are things that I try from an economic standpoint to bring to the forefront all the time. If you're going to bring an issue to the table, make certain that you bring a solution, or at least have the ability and the aptitude to be able to learn about the issue before you figure out whether it's going to be applicable to you or not. There's a difference between, looking at your financial world through a microscope versus looking at it through a telescope. It's a different view altogether, and it's critical to understand. Now, will the rich trickle down their tax benefits to their employees? One of the things that many people claim is, well, if trickle-down economics works or doesn't work, why is it that you feel that it doesn't work? Well, let's go through it very quickly. If you happen to be a wealthy individual in the United States and you get a tax deduction, or you get an increase in tax benefits, which therefore will allow you to keep more of your money, what are you going to do with it? Now, most people that truly do not understand economics feel that, well, they're going to keep it for themselves. Okay, well, if they keep it for themselves, what are they going to do with it? Are they going to put it under a mattress? No, they don't do that. That's not how the wealthy, work with their money. By the way, that's a reason why they're wealthy, because they know exactly how to use the money. Now, they may put some money away in savings. They're going to take some of those savings, and they're going, if they own a company, they're going to expand. They're going to buy more inventory. If they buy more inventory, that means that they're utilizing the marketplace more so. So, whomever they're buying inventory from is going to benefit significantly. That company may have no other choice but to hire more people in order to be able to provide for that supply and demand economics, because trickle-down economics to the wealthy, has created a tax break that has allowed them to use additional money to continue to grow their company and themselves. And by doing so, if you really understand trickle-down economics, everyone will benefit from it. Because unless you have somebody that is so eager to put their money underneath a mattress, they're going to have to do something with the money. They're going to invest it in the stock market. They may buy other companies. They may increase their employees, and by hiring more employees, by moving in a different direction, restructuring companies, perhaps even purchasing some of the stock back if they own a public company, and so forth. So there's a tremendous amount of benefits that can come from trickle-down economics. Now, bear in mind that the discussion on trickle-down economics started with the Reagan administration, when he reduced taxes significantly, and they felt that it was not going to go anywhere. And because of those tax breaks that he implemented in the 1980s, we in the United States had a tremendous growth for approximately 20 years. The Clinton years are primarily, and not taking anything away from President Clinton, I think he did a fairly good job in maintaining the status quo, but a lot of those things that were going through the Clinton years were started with Ronald Reagan, because it takes a number of years in the United States for a process to take effect and move either positively or negatively down the line. Now, so, what would you do with the money if you were rich? And this is a question that I ask, clients of mine and friends of mine that come in and talk to me about trickle-down economics. I say, well, let's say that you were a wealthy person, because I want to make it an individual situation, not talk about something that may happen to the masses as a business perspective. So I normally ask my friends when they bring this issue to the table is, well, if you were wealthy and all of a sudden you received a tax break, what would you do with your money? And let's go through it. And at the end of the day, when they finish going through that exercise, they realize that whatever it is that they're doing with their money, not only is it benefiting themselves and their families and their businesses, but in a roundabout way is also benefiting many other companies and many other people along those lines throughout that chain of events. Now, another question that I get systematically from clients, and that I hear this on the news as well, is, how much do employees pay for payroll taxes? And I'll tell you a little bit about that. I'll give you a little bit of education background on that. But whenever somebody asks me how much do employees pay for payroll taxes, my answer is always the same. Economically speaking, they pay for all of it. Let me give you an example. In 2016, the taxable wage base in the United States was at $118,500. That means that if you were an employee earning W-2 income, you were going to contribute 6.2% of your income to Social Security taxes. And Social Security would be 6.2% up to the taxable wage base, which at that point in time was $118,500. A year later, in 2017, the taxable wage base in the U.S. went from $118,500 to $127,200. So that's an increase of 7%. Now, just so you have an idea, what you do from a payroll taxes standpoint, all of us that have W-2 income, now I own a company, so I pay myself a salary under W-2 as well, but I also take out dividends and K-1 distributions along those lines that are not factored into the taxable wage base. But just for understanding purposes, when you are a W-2 employee and you're contributing to your FICA, Social Security, and Medicare, you're contributing 7.65%. Of which 6.20 goes toward Social Security, up to the taxable wage base in 2017 of $127,200. Once you hit that number, anything above that that you continue to earn, you're not going to have to pay that Social Security tax of 6.2%. Now, the other 1.45% that adds to the 7.65 total is for Medicare taxes. And those you pay on an unlimited amount as long as you have W-2 income. So if you make $500,000 on W-2 income, the first $127,200 will pay 6.2%, and then the entire $500,000 will pay the 1.45%. So that's pretty much how taxes work. But remember, the question was, how much do employees pay for payroll taxes? And economically speaking, I'll say all of it. Why? Because as a W-2 employee, you're going to pay the 7.65, and then your employer is going to match the other 7.65 for a total of 15.3. Now, here's what is important for all of us to understand. And this is why it is so critical to be able to peel down the onion and understand it from an economic standpoint. I would argue that the 15.3% is being paid by you. It's being paid by me. It's being paid by all employees in the United States. And the reason for that is simple. Salaries and employee benefits are a factor of economics. So a portion of your economically forecasted salary became taxes and benefits proportionately. So let me give you an example. Let's say I own a company and I need to hire a manager, and I have to pay that manager X amount of dollars. And when I pay that manager X amount of dollars, I have to make certain that I'm competitive in the marketplace, and by the same token, that I'm going to be training this individual to take my company to the next level. And by doing so, I want to make certain that he or she is not going to go away to my competitor at some point in time in the future. But again, I only have a number of dollars available because I'm a business owner, so I have to, do a lot of stuff with my money. And then obviously, the more expenses I have, the less I'm going to be able to reinvest in my business. So when I decide to go out and hire a middle manager or an executive for my company, I have to factor into my calculations not only the salary that I'm going to pay, but also the taxes that I'm going to have to pay on that salary, and also the employee benefits that I'm going to have to provide that individual in order for them to come and work in my company. So therefore, when I factor the salaries for a potential hire in the future, I'm going to take all those numbers into consideration. And I know that in my situation, if I can only pay $100,000 a year, I'm going to factor not only the taxes I'm going to pay on that, the 7.65%, but I'm also going to factor in the employee benefits and the cost of those employee benefits. So once I do my math, if the 7.65 and the cost of employee benefits amounts to $15,000, then the only thing I'm going to be able to pay that employee when I hire him or her is going to be $85,000. Now, that means that I already factored that in. Now, if I didn't have to pay Social Security taxes at 7.65%, perhaps if I was benevolent enough, I would be able to pay that employee the entire $100,000, obviously minus the cost of employee benefits. And when someone says, well, Bert, yeah, but that doesn't work because if you don't have to pay that tax, you're more than likely still going to pay that employee $85,000 and then you're going to keep the rest. The answer is negative to that. The reason for that, because competition drives behavior. So remember, if you're an employee and you're paying 7.65%, you're actually paying the 15.3% because your employer is factoring that 7.65 that they should have paid you, but they didn't because they needed to factor in the taxes that they need to match on your behalf. So that's something that, now obviously the majority of individuals on this call and the majority of the clients that I talk to have never actually thought of it this way, but from an economic standpoint, it is a zero-sum game. Now, another question that I get is the new tax reform proposal benefiting corporations? And my answer, again, is pretty simple. Of course it is. And it should. Now, I'm going to throw something at you, but if you apply it to what we just talked about from a payroll taxes standpoint, I think it's going to be a lot easier for all of us in this call to understand. Corporations do not pay taxes. Okay? And you say, well, why would it matter? Now, Bert, if corporations don't pay taxes, why would it matter if they get a tax reduction or not? Why does the Trump administration want to make our corporations competitive in the world? Because we're definitely not competitive in the world business marketplace from a taxable standpoint. Why do we want to give corporations tax deductions and tax breaks if, based on what you're saying, Bert, corporations don't pay taxes? Well, at the end of the day, the reason for that is competition. And let me tell you why corporations don't pay taxes. Corporations don't pay taxes. They're a collector of taxes. Because every single product and service that we as Americans purchase in the United States, taxes have already been factored in. So in reality, the average consumer, the American public, is the one that is paying the taxes on behalf of the corporation. Because if I'm going to sell a widget and I create a product, and let's call this one a widget, I know what the cost of goods is for that product. I know what my bottom line cost is. I know what I can add on top of that as a fudge factor, depending on how much inventory I need to produce and so forth. I have to factor in the taxes I'm going to have to pay on that dollar of profit on that product. If that product profit is $1, like in this exercise that I'm giving you right now, what's going to be the cost of benefits? So I'm going to factor all that in the pricing of my product. So if the government continues to raise my taxes along those lines, I'm going to have to continue to raise the prices of that product. Now, competition again, my next competitor next door is not going to lower their prices because they're going to have to pay the same type of tax that I'm paying. So all of these corporations will continue to raise the cost of that product in order to offset the taxes. And guess who pays the tax overall? The consumer, the person that has to walk into a store, purchase that widget, and by purchasing that widget, they're already paying the tax that I, as the business owner, I'm going to receive, and then I'm going to put it into a separate escrow account, so then on a quarterly basis, I'm going to pay my taxes along those lines. So we have to be very careful when we say that we should not give corporations a tax break, because at the end of the day, we're the ones paying the taxes to begin with. Now, if you reduce the tax liability as is being proposed today, it's not finalized, from 35% to as low as 20%, maybe 21, 22% once it's negotiated in Congress, then that means that as a business owner, I have the ability now to create that same widget at a lower cost. I can increase the quality control, I can increase my technology, I can reinvest in my business and get more and more people to buy that widget, because I now have the ability to sell it cheaper. And then you, as the consumer, because I'm going to sell it cheaper, now you're going to pay a lower price for that same widget that the previous year you paid at an increase of 30-40%. So at the end of the day, from an economic standpoint, we must all realize that corporations do not pay taxes. They're a collector of taxes from a business perspective. Now, another question that I get from clients, and I got this one and another one, and then we'll be done for the day, is, should I purchase term or permanent life insurance? And this is more on the insurance side of the house. And this conversation I have with clients on an individual basis and also on a corporate basis. And my answer is always the same. It really depends. And the other question I normally get from clients is, Bert, of all the different life insurance policies that are in the marketplace, which is the best type of policy that I can purchase? And the answer for me is always the same. The one that happens to be in place the day someone dies. Because at the end of the day, life insurance is a way to protect someone. And sadly enough, what I can tell you about life insurance is that no one ever dies at the right time. And I've never met a widow that did not believe in life insurance. But the difference between term insurance and permanent life insurance is similar to the difference between leasing versus purchasing or buying. And many of us, fail to make the analogies. Like, for instance, if I drive a car only for 2 to 3 years, and then I keep, switching cars on a regular basis, well, it may be more suitable for me to lease an automobile and then having to buy one. But if I'm a buy and hold car investor or car purchaser, where I may buy a car today and keep it for 10 years, then it makes a lot more sense for me to buy it than have to lease it. The same thing happens to purchasing of real estate, especially a home. If you come to me and you say, Bert, I just moved to South Florida, I'm going to be here for a couple of years. Do you think that I should buy my home, or should I rent, or should I lease? More than likely, I'm going to recommend that you either lease or rent your home. And the reason for that is simple. Although the real estate market has been doing well now for a number of years, if you're only going to be in South Florida for 2 years and you want to make certain that you want to limit your liability, then you don't have enough time to mitigate any volatility in the real estate market. So I'm going to ask you, primarily to either rent or lease. But if you come to my office and you say, Bert, I just moved to South Florida, and I plan to be here over the next 20 years or 30 years, or I'm going to be here for the rest of my life, if everything goes well, would I buy or lease, or would I buy a piece of property, or would I rent it? My answer is always going to be the same. Economically speaking, you should be purchasing instead of leasing or renting. And the reason being is that now you have 20 years, you have 30 years in which you can mitigate all the financial volatility that may happen in the marketplace, and still be able to build some equity based on the increases of real estate prices in the future, plus the reduction of mortgage principal along those lines. And the same thing you should apply to term insurance and volatility. One of the things that we do at Cambridge, and we do this at no cost or obligation to any of our clients or listeners, is that we do life insurance audits and life insurance appraisals. Many of my clients have had life insurance for a number of years, but they have not appraised and or audited those contracts in a long time. And life insurance has changed tremendously in the past 10 years. You actually have the ability to buy a life insurance contract today cheaper on a per thousand basis than you could have 10 years ago. And the reason is simple. People are living a lot longer today than they were living before, especially if you have an older policy. Anything that you have in life insurance over 5 years, you should be reviewing. Most important, there are a number of new incredible riders that were not available before. For instance, one of the major issues that we're encountering now, because of the fact that people are living a lot longer today than ever before, is the issue of long-term care. Well, long-term care is very good, and you can buy a long-term care policy, but what if you pay for long-term care premiums for 30 years, and then in year 31 you happen to die in your sleep without ever needing the long-term care policy? Well, not only did you lose the premium on the long-term care, but you also lost the opportunity cost on that premium and what you could have done for yourself and your family with that money. Well, now the new life insurance policies that are available in the marketplace allow an insured or a purchaser of a life insurance contract not only to have that life insurance, say, death benefit, and whether it is term insurance or permanent insurance as well, but you can now have a long-term care rider feature. So whether someone needs the long-term care or not, someone in your family will always receive the benefit. If you don't need the long-term care while you're alive because you died very happily in your sleep, then your survivors will receive the lump sum of the death benefit. If you needed long-term care along the way and you used a portion of that death benefit to provide for the long-term care, then the remainder would be paid to your beneficiaries as a death benefit as well. So from an economic standpoint, it is a more beneficial way of maximizing every single dollar, and that's what we call in economics a velocity of money multiplier. In other words, you want that $1 that you're putting away to be able to cover either multiple liabilities or provide multiple benefits to you and to your family, thus really enhancing the internal rate of return on that dollar that you're investing. So there's a tremendous amount of conversation when it comes to life insurance. You know, how do you choose the beneficiaries? How do you name the beneficiaries? Does it make sense to have it in a trust? Does it make sense to have it outside a trust? Are you going to use your life insurance policy as a supplementary retirement plan? Do you want to use it primarily as a death benefit? Do you want to use it as a combination of both? Have you set up your life insurance as a Social Security replacement vehicle, which is something that many Americans do not even think about, and is a critical discussion to have? So this is not the time for that, but I just wanted to give you a little bit of feedback on that. And at the end of the day, you know, I want to share the following because, you know, obviously life is like an EKG. There are a lot of ups and downs, and you know, when things are not doing as well, obviously, you know, there's a lot of pain and suffering along those lines. But you know, an EKG is good for everyone because as long as there is an EKG in your life, that means you're still alive. Because the minute you have a flatliner, that means you're dead. And that's not something that I would want to see for many years to come. But, you know, whenever I look at clients, and every client that walks into my office or every person I talk to about finances or personal life, you know, they look at life from different perspective, and there's nothing wrong, nothing bad along those lines. But I basically feel that, you know, there are three types of people in the world. And the three types of people in the world are, you know, those that make it happen, those that watch it happen, and those that just wonder what happened. So whatever you do in your life, you always have to take control. Do not allow anyone to dictate how your life is gonna be in the future. Do not allow the U.S. government to dictate, you know, how much you're going to pay for your taxes in retirement. Make sure you take control of that. Make sure that you do provisional income calculations. Make sure that you visit with someone like me or someone that is knowledgeable from an accounting standpoint that can help you do tax planning. Make sure that you try to maximize your retirement income on a tax-preferred basis, meaning tax-free income as much as you possibly can. can. And again, as we always say, I always say at the end of every one of these podcasts, my number one goal is to change the way that you see things. Because if you change the way you see things, the things that you see change. Again, when someone talks to you about all these issues that we have discussed today, you may not necessarily have to agree with me, but the reason for me to do this today in this financial Q&A is to kind of take you outside of the box and give you the ability to start thinking from an economic standpoint, start thinking and looking at your financial life and whatever goes around you through a telescope as opposed to a microscope. Again, I hope that you enjoyed our talk today. I'll see you again next week. And until then, have a great day.